All right, let's get right into it. Today, we're tackling Vishay Intertechnology's Q3 earnings. And this one is a real head scratcher because what the numbers say and how the market reacted, well, they're two totally different things. So, here's the big mystery we need to solve. How does a company beat on both revenue and earnings and still see its stock drop almost 5%? It just doesn't add up on the surface, right? So, what's really going on here? So you've got the results over here, a beat on revenue, a beat on earnings, pretty solid. But then you have the market's reaction over here, a nearly 5% drop. Our job today is to figure out what's happening in the space between those two facts. Okay, let's get into it. First up, the Q3 scorecard. We're going to peel back the layers here and look past those headline numbers. All right, so if you just glance at the top line, everything looks great. Revenue, $791 million, a nice little beat against what the street was expecting. Earnings per share, 4 cents. Again, just a hair above consensus. And look at that year-over-year revenue growth, up 7.5%. I mean, you can't really complain about that. On paper, this is a clear win. But, and there's always a but, isn't there? This is where the story starts to get a little messy. Check out that gross margin, 19.5%. That's pretty thin. Now, management was quick to point out that their big new investment, the Newport facility, is dragging that number down by about 1.5%. So if you strip that out, the underlying business is actually running at a healthier 21%. But you know how it is. Investors see that headline number, and that's what sticks. And it wasn't just the margins. Another yellow flag popped up, the book-to-bill ratio. Now, for any manufacturing company, this is a huge deal. It tells you if you're getting more new orders than you're shipping out. You always want that number to be above 1. Vishay's came in at 0.97. That's not what you want to see. It basically means demand might be slowing down. Okay, so with those signs of weakness, what does management do? They try to change the subject, right? They're trying to get everyone to stop looking at the next quarter and start looking at the big picture, this grand plan they're calling Vishay 3.0. And this is their big pitch. They're saying, hey, forget the short-term noise. Look where we're headed. They're talking about the hottest sectors out there: AI, power delivery, smart grids, electric vehicles, self-driving tech, aerospace, defense, basically all the stuff that's set to grow for years to come. And the CEO, Joel Smejkal, really hammered this point home. He basically said that all that money they spent building out new factories wasn't just for fun. It was a strategic bet. The idea is now they can handle these super fast, last-minute orders that their competitors can't. That's their ace in the hole, or so they say. So you've got this really rosy, long-term vision from management. But the market? Yeah, the market wasn't buying it. Not yet, anyway. The verdict was pretty clear: skepticism. So let's look at why investors hit the sell button. It really comes down to a few key things that spooked investors. First, that 19.5% gross margin, just too low. Second, the guidance for next quarter was meh. Basically flat, no growth. Third, that book-to-bill ratio under 1 that we talked about. And finally, that Newport facility is going to keep dragging on profits until, get this, early 2026. That's a long time to wait. And if you need a picture to see just how skeptical the market is, here it is. Look at this. Over the last year, Vishay is down 14%. Meanwhile, the semiconductor sector is up 27%, and the S&P 500 is up 16%. I mean, that's not just underperforming, that's getting left in the dust. So what you have here is a classic disconnect. Management is selling a story about 2026. They're saying, just wait, it's going to be great. But the market? The market lives in the here and now. It's focused on the next 3 to 6 months, and right now, what it sees, it doesn't like. Okay, so that's the setup. You've got the long-term story versus the short-term pain. So where do we go from here? Let's get into our outlook and see if we can spot anything that might break this stock out of its rut. So, here's what we're predicting for the next quarter, Q4. Look, we're calling for revenue to come in right around $790 million, basically in line with their flat guidance. And those gross margins, we think they're going to stay stuck right around 19.5%, with that Newport facility still weighing things down. So, what does that mean for the stock? We think it's going to trade sideways. It's range-bound. There's just no compelling reason, no catalyst for it to break out higher anytime soon. So let's wrap this all up into a final thesis. Vishay is a really interesting story. You've got this potential long-term winner that's plugged into all the right trends. But that future promise is being completely overshadowed by its current problems with execution and making money. So when you weigh that future potential against these very real, present-day headwinds, there's only one place to land. Our rating on Vishay is Market Perform. And of course, just a reminder, this analysis is for informational purposes only. It is not financial advice.